Hello, everyone, and welcome back to a brand new episode of Tax Thursday brought to you by Smart Counsel. I am your host, DDQ, here with Smart Counsel's tax resident attorney, Dionne Kellier. Happy Tax Thursday, Dionne.
Happy Tax Thursday, Dee.
Awesome. If you haven't already, make your way over to the Smart Counsel website at www.smart-counsel.com to learn more about this minority woman-owned firm. There you will find more about each attorney and their practice areas and just everything that's Smart Counsel related, including our Tax Thursday episodes. I was kind of looking back at past episodes just before doing research, and it kind of dawned on me that we are now about a year into filming Tax Thursdays. Can you believe that?
No, I can't believe it. Like we all this is super. Who thought that it would have swung this far and it was so quickly?
Right. Yeah. No, seriously, I feel like it really flew by. I remember us first starting out, the kinks and stuff, and where we really wanted to go with this. We just know we needed to get this information out there to our followers and to those who are, want to learn more about taxes. And now here we are with such a big following on Instagram. So thank you guys so much for following us on Instagram and our growing followers and subscribers on YouTube, which is awesome.
Yes.
So for this week, we will be discussing a new topic, which is how bonuses and stock options are taxed. So I guess the first question to kind of get things going is, what exactly does the IRS consider a bonus and a stock option? Let's start off with those.
So, in general, bonuses of any kind, including signing bonuses and severance pay, fit into the supplemental wage category. And other examples of supplemental wage would be accumulated sick leave, certain commissions, overtime pay, prizes and awards, back pay, reported tips, retroactive pay increases, payments for non-deductible moving expenses, and certain forms of equity compensation like restricted stock units and exercises of non-qualified stock options. So, while bonuses are subject to income tax, the IRS does not consider them regular wages. Instead, it counts your bonus as supplemental wages, and there is basically a 22% flat withholding rate. So if your job was going to give you a $6,000 bonus, then they would withhold $1,320, which is 22% of $6,000 as it's basically your prepayment of tax, right? So you're hoping that at the end of the year, everything will even out and you'll end up getting a refund and that you don't owe the IRS anything. And the job, your employer is doing it because they want to protect themselves as well, because they don't want to just be giving you money and not covering your obligation to the IRS, right? Because it'll kind of be reckless of them to give you something that is going to probably be taxed at a different rate than your normal rate. So that's what everybody's just trying to protect themselves. So your bonus may also be subject to state taxes, and the withholding rate is going to vary depending on your state. And if you receive a very large bonus, which is something that would be considered over $1 million, but for me, a very large bonus is anything additional than what I'm supposed to get.
Seriously, though, I'm like, wow, $1 okay.
Right. So if you have $1 million bonus, anything over so if you have $1 million bonus, anything under the $1 million is going to be taxed at the 22% flat withholding rate, and anything above the $1 million is going to be taxed at a 37% rate. And this is just a guesstimation, right? Because the IRS is just trying to make sure that whatever you owed would be covered and taken out versus you having to pay them at the end, right? And so if you got $1 million bonus and or if you got a $2 million bonus, you're going to pay $590,000 in federal withholding, because it's going to be 22% on the first million, which is going to be $220,000, and then 37% on the additional million, which is another $370,000, and that equals $590,000. And then in some cases, you'll have additional tax liability from your bonus, which is going to be the Social Security 6.2% and the 1.45% Medicare tax. But with Social Security, after you make $142,800, that was tax year 2022, but around, call it $143,000, then they stop taking Social Security out of your check. There's a cap for where there's a cap for the amount that you can make for when they take out the Social Security.
Okay. Okay, cool.
Right.
And so that was for bonuses or for both including the stock option as
This is
well?
just bonuses. We'll talk about stock options differently because we'll talk about stock options next because stock options, right, are just that, the option to purchase a stock. You own
Oh.
nothing, right? They
Right.
never explain it to you like that. You own
Yeah.
nothing. You have no rights. You just have the option to purchase when your vesting begins. So, like, I have the option to purchase 3,000 stock in 5 years. And so they'll never include it in your taxable income until now you do something with it.
Oh, like reinvesting it or like,
Well, until you exercise it. So there's two different types of options, and then what are you gonna do? Do you exercise the option? And so, like, okay, so today I have the option to purchase something in 5 years. In 5 years, I say, okay, I'm gonna exercise that option, but that still doesn't mean
oh,
anything because the value that you're gonna exercise at, then that starts your basis, and then if you sell it, that's what you're gonna get taxed on.
interesting.
Yes,
Okay.
yeah, we'll
So
get
yeah,
to
they
that.
do make it sound like a bigger.
Yeah, it's a everything I've realized with the IRS, the most difficult concepts. And trust me, I've had to figure some things out. Like, if you could just break it, everything could be broken down into a simpler element. And then once you understand the simple element, then you start like adding on top of it, but keep it simple. Like when you read the words, when you know, when you're reading the IRS statutes, you're like, what does
Yeah.
this say? But if you take like
Right.
sentence one and you make it easy, and then sentence two and you make it easy, and then you combine it, you're like, oh, this makes total
Makes sense.
sense. So
It's like math.
it's definitely like it's like math and statistics. The two most like what
Right.
just the hydratic equation. Like what? Well, have you ever used this? The Pythagorean theorem. Have you ever used it? Never.
Right.
but you
Right.
but we know what we're talking about, right? So
Exactly.
all right.
Okay, cool. So, what else can you tell us about the bonuses? There's like two different options
Mm-hmm.
that the employer has.
Yeah, so the employer can either do the percentage method, they can do the withholding based on the percentage method, which is that 22% flat rate. And that's
Okay.
typically what most employers do because it just makes life easier. Or they can do that the aggregate method, and what that is whatever tax rate the individual taxpayer is typically taxed at, they do a withholding on that. It's going to withhold a higher amount from your bonus, so you're going to receive less, but in the end, you're probably going to get a refund because no matter what your tax rate is versus your effective tax rate is different, right? So your
Okay.
tax rate could be 35%, but your effective tax rate, which is what you actually pay in taxes, that is probably going to be, so if your tax rate is 35%, your effective tax rate might be like 28% because you have to remember that you are allowed either standard deduction or itemized deductions, right? So your tax rate
Mhm.
based off of you making 100,000, let's call it 37%. But then you have the standard deduction, which if you're single, it's about 13,000. So you're deducting 13,000 from 100,000. So that brings you down. That changes your tax rate basically. And so
Right.
tax rate and effective tax rate, totally different things. But it makes sense, and it's all right. Like we know in the political arena, all of the things that they're when you watch these commercials, it's propaganda
Yeah,
propaganda,
for
propaganda. Oh, they're gonna raise your tax rate here. They're gonna do this. They're gonna do that. Well, what's the details of what they're saying, and
right.
that's what
Exactly.
the problem is. Yeah.
And with each of those methods, is there one that is more beneficial to the employer or to the taxpayer than the other?
The percentage method is more beneficial, I believe, to both, right? Because you're not over withholding, and you're not, and
Mhm.
you don't have to go back and do any corrective math, right? So if you just do that
Right.
that flat rate 22%, most people are gonna fall within that arena because like even if your tax rate is 22%, say that's the number,
Mhm.
each thing like each item of income is not taxed at 22%. It's all of the income taxed at 22%, right? So if you tax each thing at 22%, you're taking out too much taxes because you're not accounting
Yeah.
for expenses and additional things that just may come up. So
Hmm.
I would say that the percentage method is going, if I was the employer, I would use the percentage method.
For sure. Okay, cool. Perfect.
So let's see. So for the aggregate method, sometimes employers pay the bonuses alongside regular wages, and they have to use the aggregate method to calculate. But typically, they end up, there's a lot more work in that they're over withholding, and the IRS does not. The IRS does not necessarily love to give refunds. It just kind of works out that way. They kind of want, they kind of want you to zero out at the end of the year. They don't want to owe you anything, and they don't want you to owe them anything. They want, as you went along through the year, you're covering your obligations, and at the end of the year, everybody's even. We shake hands, and we go about our business.
Right.
And let's see. The IRS expects its cut of any bonus you receive, but as I say, the IRS expects a cut of anything, right? That's who the IRS is. And even if you receive your bonus in cash, gift cards, or vacation, or some other benefit, you generally have to pay taxes on that. And that's going to be based on the fair market value. Sorry. I'm getting over my little cold, but I'm okay. I'm okay.
We're here. We're surviving.
We are surviving. It's not the Rona, so okay.
Right.
The exception to this rule is if your bonus can qualify as an employee achievement award, and you might be able to avoid paying federal income tax under the following conditions. If the award isn't cash, a cash equivalent or equivalent, it's tickets. The award isn't cash, a cash equivalent, tickets to an event, vacation, stocks, bonds, or other prohibited items. The award is tangible property, tangible personal property, and it doesn't exceed $1,600. So basically, you may be able to avoid paying federal income tax if it is an employee achievement award and it's less than $1,600 in whatever form that it comes in.
Okay, and is that for like the year, the tax year, or is that just that one bonus that is up to that amount?
It's for that tax year from that employer. So,
nice.
Yeah. So it's not a big number, but, any little bit helps. I mean, when I see the numbers like 1,600 and then, right, so you could get a bonus for an employee achievement award for $1,600, but if you're a teacher, you can only deduct $250 for the year. I mean.
Oh, right. And we did cover
that.
Yeah.
Things like that make me crazy, but I mean, I didn't make the rules, so.
We're just here to explain them, guys.
All we can do is work within the rules. And there's something I wanted to say before we go into stock options. So I was watching, of course, on it. I guess it was Instagram. I think it was Instagram. And I saw this guy doing this, talking about an LLC, right? So, number one rule I have to say, I don't think that, you can't take everything that you hear anywhere as fact, okay? And then number two, don't let people set you up to get locked up and audited, right? So what he said was that, and I've seen things like this before, if you stitch your logo in or on your clothes, in any part of your clothes, then your clothes is going to be tax deductible. And it's an LLC, by the way. And so, I was like, you know what? I gotta watch this. I can't just watch. I can't clickbait and and not watch the whole thing to be disgusted with whatever he's saying. So I watched it. And so I'll say this. Okay, number one, and I know it's an aside, but it's on my brain. An LLC is not the only form of business, of a business structure, right? And so if you are going to be an LLC, or if you're going to be an S corporation or a C corporation, you need to know why. Know what the purpose is. Not just because somebody's saying, oh, start an LLC and do X, Y, Z. All right? So that's another thing. The other thing is, while uniforms are deductible and a deductible expense for particular businesses, not all, so not all, if you buy, you cannot go and get a Louis Vuitton outfit and then stitch smart-counsel in it and think that it's going to be tax deductible.
Right.
If your business has the ordinary and necessary expense of having clothes that may be a part of the business, but not necessarily a uniform. If you're a W-2
Mhm.
employee, it can't even happen to you, right? Or for you. But
Right.
like it doesn't work like that, right? So when somebody's giving you that kind of information, like there is so much before the sentence that they read and so much after the sentence that they read, and these are the
Right.
things that are important to making this happen. Like don't listen to
Right.
it, right? There's so many, or go to a professional. But like somebody, Joe Schmo, and not that people aren't smart, because I don't believe that formal education is the only type of like intelligent person. I know several, many brilliant people that they didn't go to college, they didn't have the opportunity. It doesn't matter. They're very well read, they understand what's
Mhm.
going on, right? But
Mhm.
don't let somebody set you up for failure. That information that that
Yeah.
person gave is true for a particular subset of people that are doing a particular subset of actions. But he's not telling you that. He's only telling you the stitch your logo and clothes. Like, I don't think it
God.
really works like that. So that was
How
definitely on my
fun.
mind. I want to save you guys from getting audited and locked up in IRS jail. It doesn't work like that.
Right. That is so interesting that he would even say something like, I've never heard of that, seen that. That's kind of funny to me.
I want to tell you I'll send it to you, but I won't even send it to you because I don't even want to give him any more plays, because like I just feel like
Right.
it's so reckless that, and the thing is that you have no recourse, right? If you take his advice, like, and the IRS comes to you, that you can't. I mean, you can say it, but the IRS is going to be like, so they'd be like, well,
Yeah.
I was watching this guy on Instagram and he said X, Y, Z. No, it doesn't work like that. So
Right.
that was my
Super catfish for sure.
super catfish for sure. Like for me, I know the IRS rules, and I don't do my own taxes because like
Mhm.
I need to make sure that we're on the up and up at all times. Me and the IRS, we got to be good. High five, we're friends. This is great. Life is gonna be good, right? So that was my aside. All right, back to stock options.
Interesting. Before we do move on to stock options, my last question for bonuses, are bonuses taxed both federally and on the state
They
level?
are, depending on your state, right? So Florida, you're lucky because we don't have personal income taxes, but like New York, for sure. Like New York, if you live in New York City, you have to pay New York state tax, New York state tax, then you have to pay New York City tax, and then you have to pay, like, if you live on the upper whatever side or the whatever side, you have to pay those taxes. So yes, it is subject to all of the other taxes that every other type of wage is subject to.
Interesting. And kind of like a side note, now that you said that, I think Colorado, because we're like in the midst of elections and stuff, was like the propaganda or whatever. They said that they were trying to get rid of personal tax income or something like that.
Personal income tax. I could.
Yeah.
It's. I mean, especially when I see stuff like that, especially, it's not gonna happen during your election. It's not. It's not. It's something that
Right.
it's written into. I want to say it's written into your state's constitution, right? Of the personal
Mm-hmm.
income taxes or not. So there's so much that has to happen, but like I hate political times, right? Like I hate these political ads, like because they really throw out these little nuggets, and if you don't care to know or you just want to be led in that direction, like you could go in any direction. You could be led in any direction. And even like,
Right.
you know, even in the world of Google, right, where you can find anything. You can literally find anything to support your position, right? It's almost like I don't even hear me out. It's almost like in the Bible, right? How you can find a verse in the Bible to support
Oh,
whatever
yeah,
you feel. Good,
for
bad,
sure.
ugly. Women should be in the house. Women should work. Women should be, should be judges. Women should only bear children. Like you can
Right.
find a little sentence somewhere that will support your position, and that's how I feel about Google. But I still feel like it's a good starting place.
Right. You just have to keep digging. You can't just like stop at that one first link that pops up.
Exactly.
You know, you
Exactly.
have to definitely keep digging. And that's funny that you say that because that's what I thought about when you were talking about like taking that one line. You have all this supporting that makes that line, true. That's just how, I don't know, society works.
And that's how society works. And funny enough, that's how the law works, right? Because like we as lawyers can use the same case to on the pro or the con side, right? Like we will
Right.
literally use the same case, and you'll take the line out of the first page of the opinion, and I'll take the line right before they issue the opinion, and we're not wrong. We are just utilizing what supports our position, and that's
Right.
people in
For
general,
sure.
right? So I take
Sure.
everything with a grain of salt, especially political ads. Oh my god! Like I would, my nightmare in life would be to be a politician.
That would be so funny
That's
though.
my nightmare, my literal nightmare. Yes, I wake up like, so yeah. Okay.
Well, so let's go ahead and move on to stock options and how that looks like and how those are
Okay,
taxed.
perfect. So, stock options are employee benefits that enable them to buy the employer's stock at a discount to the stock market's price. The options do not convey any ownership interest, but exercising them to acquire the stock does. And there are different types of stock options with their own results. So there's two kinds: incentive stock options and non-statutory stock options. So the difference is that incentive stock options slash ISOs, that's what they're typically called, they are for people who are employees, current employees of the employer. Whereas the non-statutory stock options, those are for like independent contractors, somebody who, if you got fired from the position, you have some time, like you have a limited amount of time to redeem it, but you'll have a non-statutory stock option. So basically, if you are currently employed by the employer, it's going to be an ISO. That's like, just so you know the difference, because I didn't know the difference at first.
Yeah, no, for sure.
Um, sorry. If
It's okay.
if your employer grants you a statutory stock option, which is an ISO, you generally don't include any amount in your gross income when you receive or exercise the option. However, it may be subject to the alternative minimum tax. We talked about that. It's basically, alternative minimum tax is there to catch people who skirt the IRS laws. I mean, higher income earning people are the ones that know how to manipulate the system.
Yeah,
Best way I can
for
say
sure.
that. All right. You have a taxable income. You have taxable income or a deductible loss when you sell the stock you bought by exercising the option, and you generally treat this amount as a capital gain or a capital loss. If you held it for 365 plus 1 days, it's going to be a long-term capital gain or loss, and you get preferential tax treatment. If it was held for 365 or 364 days or less, then it's going to be a short term, and it's going to have ordinary income. It doesn't have preferential tax treatment. And
So meaning it'll be taxed like taxable
like
income?
regular income, like your paycheck.
Okay. Okay.
Right? So it's
Okay.
ordinary income. So ordinary income, short term capital loss, or short term capital gain, excuse me. Ordinary income, short term capital gain, highest tax rate 37%. Long term capital gain, highest tax rate is 20%.
Okay.
The grant of an ISO or other statutory stock option does not produce any immediate income subject to regular income taxes. And similarly, the exercise of the option to obtain the stock does not produce any immediate income as long as you hold the stock in the year you acquire it. Income results when you later sell the stock acquired by exercising the option. However, exercising an ISO produces an adjustment for purposes of the alternative minimum tax. You just have to include it. In your worksheet, so the IRS sees that you did the work, but it's not includable.
Mm-hmm.
Let's see. So a non-statutory stock option. If your employer grants you a non-statutory stock option, the amount of income to include and the time to include it depends on whether the fair market value of the option can be readily determined. What is a readily determined fair market value? If an option is actively traded on an established market, you can readily determine the fair market value of the option. Yeah. And if it's a not readily determined fair market value, which most non-statutory options don't have a readily determinable fair market value, there's no taxable event when the option is granted, but you must include the income in you must include in your income the fair market value of the stock received on exercise less the amount paid when you exercise the option. And you have a taxable income or deductible loss when you sell the stock you receive by exercising the option, and you generally treat it as a capital gain or loss. And for this type of stock option, there are 3 events, each with their own result: the grant of the option, the exercise of the option, and the sale of the stock acquired through the option. The receipt of these options is immediately taxable only if the fair market value could be readily determined, but typically it's not. And in most cases, there's no readily ascertainable value, so the granting of the option does not result in any tax. And when you exercise the option, you include in income the fair market value of the stock at the time you acquired it, less any amount you paid for it. And this is an ordinary wage or ordinary income reported on your W-2, therefore increasing your tax basis in the stock. And later, when you sell the stock acquired through the exercise of the option, you have to report the capital gain or loss for the difference between your tax basis and what you receive on the sale.
Wow. Okay, so that's a lot.
It is, yes.
That's a lot of information when it comes to stock options, and that's just so I can get like a better idea of this. Stock options is pretty much your employer giving you the option to invest or to have stock as like a bonus.
Exactly. So
Is that
it's like this, right? So you start working for a company, so typically a startup company that doesn't necessarily have the money to pay you now, right? So they're like, listen, if you stick with us and, we can only pay you like a nominal amount now, like $100 a week, and that's it. But if you stick with us, then we're going to grant you these options. And the options typically have a 1-year cliff and then 4-year vesting. So it's like this: after you're here for a year, then then these options start to become available to you, but not all the options. So if I'm going to grant you 200 options total after the first year, then each month for the next 4 years, options start becoming available. And you can break it down however you want to break it down. So like after your 1-year cliff, and then now you're in your first year, say that a quarter of them vested, or a quarter of them vested. They vested, so you have the option to purchase them at this time. So when you have the option to purchase them, so on the day that they grant them to you, there's no value because we don't know what it is. We won't know the value until they start to vest. And there should be a fair market value, and it's your employer is granting it to you. And then if you're like, okay, I want these, then it's including your taxable income. But what if you don't want them?
right?
Then
Right.
you don't. Then it's not like forced into your taxable income. It's just like, okay, these are gone.
But you still have to like fill out that worksheet so the IRS knows, right?
Right. Well, you have to let them know like how many options you accepted for the year. So you still have to fill out something to let them know, like, okay, I was granted 100 options, but I only took 50, and I left 50 on the table.
Right.
And that 50
Right.
is just, in oblivion until somebody wants those 50. And then now, today, like say it vests today and the fair market value of each of the 50 was $1, like, okay, that's great. So I take them, and I'm like, yes, I'm going to take them today. That $50 is included in my taxable income, right? Then I hold it for 3 years, and now, what did I say? It was $1 a piece, so now it's $10 a piece, so that's $5,000. So now I just made $4,050 on that, and I would pay, if I held it for 365 plus 1 day, then I would pay at the highest rate, 20%.
Okay, that makes sense.
Yeah.
Yeah. Okay, that definitely makes sense. I didn't even know that employers could give employees a stock option like
You
that.
can. So they do it a lot. And of course, I see it a lot in this space, but a lot of publicly traded companies, right? Publicly traded is better because the price is going to be determined. Like, you can see what the price is. It's going to be, it's on the stock market. They can't change it. In private companies, it's a valuation. Well, we think the company is worth $17,000, and so each stock is going to be worth X, Y, Z. And what happens with the private companies, and I see this a lot as well, is like they literally are pulling these numbers.
Yeah.
And
Yeah, for sure.
Yeah. And the IRS is like, the thing with the IRS is if you have a low valuation, the IRS is going to be like, well, how did you get to this number? Well, like, we need to see this. If you have a high number and then you try to back out of it, the IRS is going to be like, wait a minute, this is your number. Sorry.
You chose your number, so
Right.
stuck with it.
Exactly.
Interesting. So what happens if a taxpayer does not include these stock options on their tax return?
Oh, they're going to get audited.
Yeah,
Yeah,
for
they'll get
sure.
audited. And then there's another wrinkle to it, right? If you get restricted stock, if you get an offer of restricted stock, it's an offer of restricted stock option, actually, and you choose to pay the tax on the fair market value of it today, right? You're like prepaying tax. Then when it vests, you only have to pay tax on the gain when you sell it, as opposed to the value of it when it vests. And that's called an 83B election. You can only make it within 30 days of the offer, but it has to be stock and not options, because options you own nothing.
Right. So, interesting.
Very interesting
There's
stuff.
always like a little loop.
Yeah. There's always a little loop. But, and this is this is employer stuff. And there are tax attorneys, there are tax attorneys that do everything, right? So there are tax attorneys that do just employment stuff. Employer-employee relationship stuff, that's it. And there's just tax attorneys that do like wills, trusts, and probate stuff. And there's just tax attorneys that do international stuff. And there are just tax attorneys that do corporate stuff. Like, because you cannot know everything. Like, for me, I can get us through an employment, I can get us through the initial conversation, but then I am going to find a tax attorney that does employment stuff to help.
Yeah, it's like their specialty.
Exactly. Yeah.
Awesome. Okay, so what else can you tell us, or do you have any other information on stock options before we do move on to our takeaways for our episode?
No additional information other than, I really just have the takeaways. So the stock options fall into two categories: statutory, that's granted under purchase plans or incentive stock option plans, and non-statutory options that come with no plans. And statutory is for a current employee. Non-statutory is for like an independent contractor, or I wouldn't say a former employee, but kind of like that.
Yeah.
Income results when you sell the stocks acquired by exercising statutory stock options, which may produce the alternative minimum tax. And if you make the exercise a non-statutory stock option, you must include the fair market value of the stock when you acquired it, less any amount you paid for it. And when you sell the stock, you report the capital gains or losses for the difference between your tax basis and what you receive on the sale. Sorry.
Okay. So those are our two options, is the bonuses and the stock options. And those are our takeaways for our episode when it comes to those two options. And they're both employee based, which is something that I guess I could say I learned from our discussion today. I didn't even know stock options were an option when it comes to employees and bonuses and stuff. And pretty much if we just have any further questions on this, we can reach out to you or to an employee specific tax attorney that can give us a little bit more detail on how to really manage those kind of bonuses.
Exactly. And there are employment attorneys that aren't tax attorneys, but they are going to consult an employment tax attorney.
Okay, perfect. Well, that was very interesting. I mean, I feel like it's such like a complicated topic, if that makes sense, when it comes to the two and how you can really maneuver your way through them as taxpayers. But yeah, I think that was really great. And if you guys do have any further questions, DM us on Instagram or shoot us an email at attorney@smart-counsel.com. And we're more than happy to answer those questions, figure it out with you, send you the right direction if it does get a little bit too detailed with anything.
Exactly.
But yeah, I guess until next time, Dionne, just no other questions on my end, no other information. Make sure that you guys are following us on Instagram and all of our social media platforms, that you like this video and leave a comment below, and make sure you subscribe to our YouTube channel so you don't miss out on any future Tax Thursday episodes. Until then, we will see you guys next week.
Right. Have a wonderful day.
You too. Thanks so much.